Well, good evening. Thank you for coming. I have the great pleasure to have the opportunity to talk to you this evening about a very depressing topic, I'm afraid, and I won't be able to give you much in the way of good cheer from it. I'm very glad to have the opportunity to do so, not least because one of the things I do in University College Dublin is work with colleagues in the John Hume Institute for Global Irish Studies there. And it's a pleasure to be able to do this collaboratively with the corresponding institute here and to welcome its creation and wish it and Ronan the very best of luck. Just a little bit about myself, and then I'll tell you what I'm going to do in the course of the talk. Ronan mentioned that I started my career in the Central Bank of Ireland, and that used to be a proud boast. That was something that you would say. And then things went downhill when one went into research on poverty and income inequality. And now I'm afraid, as the speaker a couple of weeks ago will have brought out, it's clearly the case that a failure in regulation, a failure in terms of it's not currently the central bank that does the regulating. It's a parallel institution called the financial regulator, but there were enormous failures there. But as I'll try and bring out, that's only one of the elements to what has us in the mess we're in. So what I want to try and talk about is, first of all, the main emphasis I want to place in the talk is on trying to answer the question that we set at the start, which is who bears the cost. And I suppose you might say that the answer is simply everybody, and that's true, but it's not going to be proportionate. So who's going to disproportionately bear the cost, I suppose, is a way of framing the question. But in order to answer that, I'm going to have to talk, for the earlier part of the talk, about the nature of the crisis, the nature of Ireland's economic disaster, which I'll try not to, I could spend the whole talk talking about that, and there would still be plenty more to say, so I'm going to try not to do that. I'm going to bounce off the slides and get to the distributional implications fairly rapidly, but in order to understand those, I think it helps to get a real sense of what, of the what and the why. Why has Ireland probably the most severe recession in this, what people are calling the Great Recession? Why have we got what is now being described as the most expensive bank bailout ever in history? Now, I've no idea whether that's correct, but it's clearly an extremely serious financial crisis, fiscal crisis, and economic crisis that we're going to be a very long time digging our way out of. So I'm going to talk a little bit about that. But I just wanted to I was struck as I traveled. I'm a great admirer of the late Tony Judt, and I was reading his little book called Ill Fares the Land, and it bears on Ronan's introduction. He has a paragraph about Ireland, which I'll just read very briefly to you. Of Ireland there is little to say. The so-called, quote, economic miracle of the, quote, plucky little Celtic tiger, unquote, consisted of an unregulated, low-tax regime which predictably attracted inward investment and hot money. The inevitable shortfall in public income was compensated by subsidies from the much-maligned European Union, funded for the most part by the supposedly inept old European economies of Germany, France, and the Netherlands. When Wall Street's party crashed, the Irish bubble burst along with it. It will not soon reflate. And that was written a year ago, or slightly more. And there is some truth in that encapsulation, but I think it misses a lot of what has actually happened and what were the drivers of the crisis, which I'll come to. Now, you as Ronan said, you read the newspapers, you look at the magazines, you see these very depressing. You know what this is. This is one of these ghost estates, as they're now described, which are literally up for bulldozing, because there is substantial housing built in places where nobody wants to live, and nobody was ever going to want to live, driven by tax incentives, which I'll come to. But I should say that the link with what Ronan said in the introduction and with this book is that here the core argument is that we have lost the capacity to debate issues of efficiency and equity in the way that we did 30 and 40 years ago, and that now the focus is entirely in an economistic language about efficiency. And that in some sense, what's striking about the crash is that Tony Judt might have hoped that that would change that discourse. I see strikingly little evidence that it's done so in Ireland or elsewhere, and that when Ronan says it's not a matter of going back to where we were, most of the discussion in Ireland, I'm afraid, is about how can we get back to 2000. So we'll talk about the implications of that sort of mindset as we go. So just to touch on, as we start in, if we're going to think about the distributional impact of the crisis, it helps to have some sense of what the distribution of income and wealth and poverty in Ireland looked like as we came into the boom, or as we came through the boom and into the bust. And I think there's some misperception of this in Ireland. The grouping that was mentioned of the 6 rich English-speaking countries is a grouping that actually makes some sense in terms of, or at least the majority of them, in terms of being rather similar in structures and in degree of income inequality, with the US being the outlier. Ireland is relatively unequal in old European terms, in other words, compared to the countries of the EU 15. But compared to the countries in this English-speaking bloc, Ireland looks very normal. Ireland has a level of inequality as captured by a standard measure of inequality, the one that tends to get used most of the time, the Gini coefficient. Ireland's Gini coefficient is, and always has been since we were able to measure it, which goes back to about 30 years ago, always has been in the high but not dramatically high range for an OECD country. So about 0.31, 0.32. Now this is actually about where Australia lies. Last time the OECD measured it, now I'm very conscious there are people in the audience who are going to make a liar of me and are going to say that these numbers are wrong and that actually Australia looks very different. But as far as the OECD are concerned, Australia looks rather like Ireland, or Ireland looks rather like Australia in terms of the overall degree of income inequality. Now strikingly, when I got into this, that was what you would say about the UK as well, but not anymore, because the UK now has a rather higher level of income inequality, and the USA a good deal higher again. So what happened in the boom was that, remarkably, and nobody will believe me when I say this, the overall level of income inequality doesn't seem to have changed very much in the course of the boom. Now, everybody believes that income inequality grew markedly in the boom, but that's not what the statistics suggest, except perhaps at the very top. The very top probably did particularly well, but there doesn't seem to have been that much change overall in the shape of the income distribution otherwise, for reasons that are important to understand and we'll come back to when we talk about the impact of the bust, because it's in a sense the same channels going into reverse. And what tends to happen is that you have a number of different channels of influence pushing in different directions and some tendency for them to balance out. But what's very important is that over the boom, living standards throughout the distribution rose very substantially. And if you measure poverty against a fixed standard of living, poverty fell quite markedly in the boom, because living standards, real incomes, purchasing power, rose not just in the middle and towards the top, but also towards the bottom. Again, that's something that at the height of the boom was contested, and people would say the Celtic tiger never came here. The truth is the Celtic tiger came most places in terms of an increase in real incomes, in the purchasing power of incomes. So that's the context in which we hit the buffers. Now, why did we hit the buffers so dramatically? Why are we having the worst recession of pretty much anywhere as a result of the global economic crisis? Well, I suppose people now are distinguishing, and this is not pure hindsight, and that people would have done this 3 or 4 years ago before the crash, distinguishing between the good boom and the bad boom. The good boom being the first half of the Celtic Tiger period, when growth was most rapid, unsustainably rapid, fastest in the OECD, but was driven by exports and was accompanied by a very substantial increase in productivity. What happened around 2001, 2002 was that this went into reverse. Productivity fell back, export growth fell back as incomes rose quite rapidly and exporters became less competitive. But also there were a succession of policy failures, which, it has to be said, were flagged up at the time. This is not pure hindsight on the part of the economics profession, in that the government did at least 2 things that turned out to be calamitous. One was the fiscal expansion was much more expansive than it should have been. At a time when the economy was booming, what you learn in first-year textbooks and still, is that the government should be trying to withdraw demand from the economy. Instead, and not unrelated to the electoral cycle, the government pumped money into an already overheated economy. Famously, the Minister of Finance at the time, Charlie McCreevy, said in a quote that I think will go to his grave with him, "When I have it, I spend it," which is not really what Keynes suggested was a good plan. So that had all sorts of ramifications to it. First of all, in terms of the government budget, as I'll come to in a minute, but particularly in terms of overheating the economy, and in particular overheating the construction sector and shifting resources from the export sector into domestic demand and particularly into the construction sector. Now, to compound the problem, the government put a lot of tax incentives in place which encouraged property investment, property development, and building these houses that you saw earlier in places where nobody was going to want to live. So developers were incentivized to build them, and investors ordinary folk, like you and me, were incentivized by very substantial tax breaks. You could make a very major reduction in your income tax bill by investing in a property like this, renting it out, or even not renting it out, because you didn't have to, because you were going to get a capital gain because the price was going up year by year. So it was a no-brainer to get on this merry-go-round. You were going to get a big tax break, and you were going to see the value of your investment increase year by year, and you could cash in. So ordinary folk, not the top 1% or the top 10%, people in the middle of the income distribution got into borrowing from the banks to buy these sort of investment properties. Many of them in Ireland, some in places as far away as Bulgaria. And I think it's no exaggeration to say these were people who didn't know where Bulgaria was. And I don't mean that in any disrespect, because I'm not that sure myself. But literally, this was the mood of the time, that you were a mug not to get into this. So the combination was that you got this enormous run-up in house prices and property values. And this is what happened to house prices compared to consumer prices. Tripling in the price of housing adjusted for the increase in consumer prices. So all that was also fueled, as well as by macroeconomic folly, which is related to political advantage. It didn't just happen in the abstract. This was combined with, if you like, very bad luck by the fact that we were now in a very different situation in terms of our currency and our banking system because we had joined the fledgling euro. So the fact that Ireland was in the Eurozone meant that, first of all, interest rates were very low, much lower than they should be in an economy that's growing very fast, when you'd expect one of the natural automatic ways of taking some of the steam out of the economy be to see interest rates rise. So that wasn't going to happen because growth was relatively slow in the core countries of the Eurozone. But the other part of it, and everybody sort of saw that all right, but you might have thought that would then be taken into account in the government's in the government's fiscal policies. So the government should have been taking out the money all the more because interest rates were lower than they should be. But instead they were pumping it in. So the other and less obvious feature of being in the Eurozone was that it meant that Irish banks could borrow in euro from our European partners, for example, or from British financial institutions and investors, and lend that on to Irish borrowers. So, and you'll see the figure there for the staggering rate of growth in the indebtedness of Irish banks to the rest of the world. So now, rather than Irish banks being constrained in their lending by the amount of deposits they could get in from Irish depositors, now they don't have to worry about that anymore. They can rely on German depositors, ultimately. So the Irish banks had ready access to funds that they could lend on into the Irish market, and boy, did they. They lent on very largely for property development and property purchase with very little effort to check whether people could afford to repay these loans, because in a sense it didn't seem to matter because this was going to go on forever. Price increases were going to make the purchase right. They were going to validate it, so you didn't have to check the incomes. We think of bankers' jobs being to check that when they lend you something, that you're actually able to pay it back, and that we think of them as being very cautious, and it's very hard to chisel the money out of them. That's the traditional mindset that we tend to have. The banks got into a situation where not only were they hurling money at property developers, literally cold calling them saying, do you want to borrow 25 million to develop this site or that site? I hear this site's on the market. Are you interested? We'll lend you the money. But also writing out to ordinary folk, again, like me, you get a letter in the post saying, you have been pre-approved to borrow 25,000 euro or whatever. Come and talk to us. So money was flooded into the economy, much of it going into property. So you've got a situation where the bank, and this of course is one of the central planks of the crisis. So banks were lending to private individuals, to developers, to builders, and so on, for commercial property and house property. The ultimate security is the value of the property. If that goes away, then the banks are bunched, to be technical. And that's what happened. The house price bubble, and boy was it a bubble, burst. Now, I think the Spanish house price bubble may actually have been slightly, the run-up may have been slightly, or rather the price fall there since the peak has been slightly larger. But the scale of the increase was not as sustained. So now what you've got is that essentially house prices have fallen by half. Property prices have fallen by rather more, land prices. So if you're a bank and you've lent a developer 100 million to buy a site, that's the security that you have. That's what you're sitting on. And that the value of that property, let's suppose, to be charitable, that it was 100 million at the time you lent the money, now it's 25. So that's the simple explanation for why Irish banks are bust. Now, so I won't go through this. You've heard about the banks. But that is why the banks, when people began to do the sums and realized that the banks were bust, they found it very hard to fund themselves. Nobody wanted to lend them money to keep going. They became completely reliant, and are still completely reliant, on the European Central Bank and the Irish Central Bank to lend them money. They currently owe those two, between them, something of the order of 250 billion. The Irish government stepped in 2.5 years ago when it became obvious that a classic old-style run on the banks was quite possible. They stepped in and they guaranteed all the liabilities of the Irish banks. So anybody who had deposited money, no matter what amount, big or small, but also anyone who had lent money to Irish banks, was guaranteed that they would get their money back. And this is where you then get into this really rather tedious argument about bondholders, and whether bondholders, who are people who have lent money to the banks essentially, whether they should be feeling some of the pain, or whether they should be getting all their money back. And much of, rather more of the attention in Ireland than I think is merited, has gone on this question, on whether, including in the recent election, whether the bondholder should be, quote, burned or not. Now, essentially, the ECB and the European Commission has been very, very negative about seeing bondholders burned. And the what get called the senior bondholders, we can go into this in the discussion, haven't been at all. But the net result, as Ronan said, we have now had 5 goes at recapitalizing and bailing out the banks. 5. It started with $1 billion. And this was, quote, the Minister of Finance at the time, the cheapest bank bailout anywhere, or the most effective, the most cost-effective, I think was the phrase he used, bank bailout anywhere. Now, as I say, we've gone back at it and back at it and back at it and back at it, and now it's 70 billion euro. Now, just to give you a context for that, Irish output, the value of total output of the Irish economy every year is only modestly greater than that sum. And it's that proportionality, 70 billion bailout for 125, that should be billion, thankfully, GNP, that's the proportionality that makes this the most expensive bank bailout anywhere. Now, so we can come back in discussion to the nature the underlying causes of this crisis, which you can, depending on your taste, you can trace to the political system, the way parties are funded, the way the voting system works, a whole bunch of other things. But let's stick to what happened when we hit the buffers. So we've seen the banking crisis, but this has been accurately described as a tripartite or a 3-part crisis, that it's a banking crisis, an economic crisis, and a fiscal crisis, all wrapped into one. Now, I should say, one of the things I'm happiest about is that over the period from about 1998, I consistently refused invitations to go places to talk about the Celtic Tiger and how other countries could learn from it. So I don't refuse invitations to talk about this, but it doesn't, because I think it's something that I know a bit about and other countries can learn from. But it certainly doesn't give me any satisfaction to do so. So where are we now? We're in a situation where the fall in GNP has been greater than anywhere else. And in that sense, since the onset of the crisis. And in that sense, as well as the bank bailout being the outlier, the recession is greater in Ireland than elsewhere in terms of the fall in average income or GNP per head. We had 10 happy years of very low unemployment. Unemployment at 4%, long-term unemployment down below 2%, numbers that we never thought were going to be possible to achieve, much less sustain for such a long period. But now that's been entirely reversed. Unemployment's gone back up to 14%. That's not as bad as it was in the 1980s at the height of the crisis then. Maybe we'll get there, but I think one of the surprises has been that unemployment climbed very rapidly to 14%, but then plateaued and hasn't been climbing very rapidly over the last short while. Now, of course, many of you will be aware that, again, those same 10 years when we had the very rapid growth were remarkable for Ireland in that, for the first time ever, there was net inward migration. Ireland is famous for exporting people as well as other things. And we did continue to export some people over that period, although a reduced number. But what was really striking was the number of people who were coming in to work because there were jobs. Now, it's not surprising that as the jobs disappear, that migration pattern goes into reverse. So we've now got significant, although again not as great as in the 1980s, out-migration again. Now you might say, well, that's just the folk going home who came when times were good, but it isn't. What's interesting is that quite a few of them have stayed. It's not entirely clear from the statistics, but there was very substantial inward migration from, for example, Eastern Europe after 2004 when the EU expanded. And it's thought, I'll put it no stronger than that, it's thought that about half the people who came in the period from 2004 to 2008 or so, early 2008, about half of those have gone, but about half seem to have stayed. So there's substantial out-migration of Irish folk as well, particularly in the younger age groups. Now, I was saying that the three-part crisis, so we have a banking crisis and an economic crisis, but we then, crucially, have a whopping great fiscal crisis. Now, why do we have such a big fiscal crisis? Well, fiscal crisis means that the government is spending a great deal more than it's taking in revenue. Again, this here, Ireland gets the dubious honour of being off the scale. When the Eurozone was set up, the deal was that countries would keep their fiscal deficit, the amount they're spending compared to what they're taking in, at no more than 3% of GDP. So that's the number to have, if you like, as a point of reference. Now, Ireland's fiscal deficit, as the crisis really bit, rose to 14%. It had been the government were actually about in balance. So it went from 0 up to 14% very, very rapidly in the space of 18 months. Now, in 2010, the number that you might see covered in the newspapers, and the number that's, again, a real outlier, bigger than Greece and so on, is that the fiscal deficit hit 32% in 2010, 32% of GDP. Now, that's slightly misleading because that's the difference between the 14 and the 32 is due to money that was put into the banks. So that's not a separate fiscal crisis. That is the bank bailout. And in fact, the government got a bit of a surprise because they thought that the accounting rules adopted by the European Statistical Office were going to allow them to put that money in to the banks in a way that didn't appear in the fiscal deficit. And they got rather alarmed when the statistical authorities said, sorry, actually, that does count as government spending. So the 32% is misleading. It's now back down to something more like 12%, but still a huge challenge. And of course, what tends to get very problematic here is if the ratio of the fiscal deficit, the borrowing by the government, if that, as a proportion of GNP, is rising rapidly, then that gets to be highly problematic because you're borrowing. If you're borrowing, somebody has to be willing to lend to you at an interest rate you can afford. Our debt-GDP ratio was rapidly heading towards 100% and above, and at that point, the money markets, as they get described, in other words, international lenders, got very leery about lending to Ireland and decided that the chances of them getting their money back were so significantly reduced that they were going to demand a very high interest rate. So the interest rate on Irish government bonds doubled. At the same time, the banks got themselves into the situation I've described, where they were entirely reliant on the European Central Bank for money day to day to keep going. It was that combination that led to Ireland having literally no choice whatsoever, as in the ECB said, we're going to bail you out. So there was a bit of political play acting where the government, the way this works is the government has to seek help. Help cannot be forced on you. So the Irish government asked the EU and the IMF to come in and bail us out. But of course, the Irish government was left with absolutely no choice, because essentially the European Central Bank said, if you don't, we're not going to keep lending your banks money. So what that amounted to was that instead of the Irish government and the Irish banks having to try to fund themselves from private lenders and financial institutions, both were now being funded by Europe and the IMF. And of course, that comes with a set of very stringent conditions. Now, the only thing about those conditions is that, in effect, you wouldn't get universal agreement on this, but I think most people would accept that the conditions laid down in this case, not always by the IMF, for example, but in this case are probably the things we were going to have to do anyway. So it's not that we're going to be doing things very differently. We're going to do what we were going to have to do anyway to get the fiscal deficit down very sharply in order to meet the conditions that the IMF and the EU set. Now, what has the government done and what impact has this combination had on incomes? That's what I want to come to now. So, unsurprisingly, the government has had to raise taxes. It has raised particularly direct taxes, income taxes. I should have said that one of the reasons the fiscal deficit grew so rapidly was that in the boom, the government became very heavily dependent on tax revenue from property transactions and from capital gains tax, both of which dried up completely when the property bubble burst and the property market froze. So one of the things that happened in the boom was that taxes were cut, particularly direct taxes were cut. So that's gone rapidly into reverse. They've also cut public service pay in a way I'll describe in a minute, and they're actively trying to cut the numbers in the public sector because, as you'll know, much of public spending goes on wages and salaries. They've cut what we call social welfare payments, payments to the unemployed, those who can't work because they're ill or disabled, and so on. I'll talk about the details of that in a minute. They have done their very best to reduce other aspects of current and capital spending, and they cut the minimum wage. Now I'll come back to all of that in some more detail. But in a sense, that's the broad strategy that the government has adopted to try to get the fiscal deficit under control. Now, I'll go into the details of particularly the tax increases and the social welfare cuts in a moment. But just to get a sense of what this does to the distribution of income. In other words, to go back to the question we started with, who bears the cost? Well, the most obvious, and probably in a real sense, as opposed to a financial sense or just a financial sense, the greatest burden is being borne by those who become unemployed, or those who now can't get a job, who would have been able to get a job before. So you've got unemployment going up very dramatically. One tends to read about a particular form of unemployment that's sort of interesting for the newspapers, which is when professionals become unemployed and can't get work. Architects, unemployment rate among architects, over 50%. Architectural firms going bust all over the place. Engineers, those professions very heavily reliant on the construction sector, which has shrunk very rapidly. So you might get the impression that this is a very different sort of unemployment to the unemployment that we're used to and that we saw in the 80s. But that's only true up to a point. The bulk of the unemployment is still being borne by the people who would have borne it before when unemployment was high, which is the people who have the lower levels of skills, lower levels of education. So, but and that's where I'll end, that looking to the future, if we think about who's going to bear the burden, this is probably the group that you should be putting most of your emphasis on. And it's striking that it's the group who have received remarkably little attention in public debate and in particular in actual policy implementation to date. There's been some talk, very, very little action focused on tackling the situation of the unemployed. Now, so they're the most, the group I certainly would be highlighting as those most seriously affected by the bust. But there's plenty of pain to go around. Many people working in the private sector saw a decline in their earnings. Now, this could happen for a number of different reasons. It has happened that people's nominal wage rate has been cut. The amount they get paid per hour sometimes was cut in particularly exposed sectors, construction, services. But for the most part, the declines in earnings have been more to do with declines in, for example, overtime. Overtime might disappear, so your hourly pay will go down for that reason, rather than a straight cut in your rate, which tends to be very difficult to implement, even in a recession. And of course, a lot of people have seen their work go from being full-time to being reduced time. So it's not get very messy and muddy, but it seems that earnings in the private sector may have fallen by as much as 10%. But it's worth emphasizing that's very patchy. Some parts of the private sector, as Ronan said in his introduction, have been doing very well. Exports have picked up very well. Earnings in the private sector have fallen significantly for some and have risen significantly for others. So it's not a simple story there. One of the things that happens in a boom, of course, is that profits go up, and in a bust, they go down. And this, again, is very important in thinking about who is going to be affected, because people earning substantial profits or incomes related to profits, people who have their own business or manage a business, very often they're going to be hard hit in a recession, and that has certainly happened in the Irish case. Now, they're going to be in the middle and upper parts of the income distribution. Public sector pay has been cut substantially. I'll show you the numbers. Again, people in the public sector, by and large, are not towards the bottom of the income distribution. Again, I'll show you the details. But again, in thinking about where has the pain been felt, the pain has so far been felt throughout the distribution, because these different sources of income go to people in different parts of the income distribution, and all have there have been declines for many of the recipients. Now, if you think about people's assets rather than their income, perhaps the most striking impact of the bust has been that if you were sensible and you did what your mother told you, which was always be careful with your money and put it into bank shares, you will have seen that money disappear almost totally. If you put it into the best performing bank, what used to be thought of as the really, really traditional conservative Bank of Ireland, that whatever about those cowboys in the other places, you could rely on them, your shares will have gone from about 20 euro to about 30 cents. So there's a lot of very sore people. I was in a supermarket queue on Sunday, and a friend of mine was in the queue next to me, and we struck up conversation, and he pointed to the top of the queue and he said, "Is that," and I won't name him, who was chief executive of the aforementioned bank. And my very mild-mannered friend did this and said, "Go and give him a punch. I've lost a fortune on that guy." So if you put your pension, your nest egg, if you put it into bank shares, it's gone. Now, that obviously affects people who did that individually, but of course it also affects the value of pension funds, where professional investors invested your hard-won savings into pension funds. So they've gone away as well. So that's a very striking and measurable impact of the bust. And of course, while not everybody holding bank shares was by any means rich, those again are people in the top half of the distribution, of the income distribution. Not right at the top, because people right at the top tend to be well diversified in their wealth holdings. So they will have seen some losses, but the statistics suggest that they were better cushioned. They had a better spread of assets than the people who had all their money in one form of asset, like bank shares or like property. But the decline in property values is, of course, the other big shift in wealth. So, and this is where, in some sense, you can regard it as being particularly unfair. Now, it's very unfair if somebody sees their life savings invested in the safest assets they could think of, which they were told by all the professional financial advisors were as safe as a house. That's very unfair. But what's particularly unfair generationally is if you got into the property market in the last 7 or 8 years, or in the 7 or 8 years up to the bust, you will have borrowed up to the hilt. The bank will have encouraged you to borrow a very large amount, an amount they wouldn't have lent you before with your income, and you will have stretched yourself to the utmost to buy a very expensive house, and now that house is worth half what it was. Well, half if you bought right at the peak, but a fraction, some fraction between a half and, let's say, 75% of what you paid for it. But of course, if you borrowed 100% of what you paid for it, then you're in very serious negative equity. Now, this is a matter of very pressing concern in the short term, because if people default on their mortgages, then that's more bad news. And the money that was put into the banks last week was very largely focused on, was informed by what yet another stress test of the banks, which took a rather negative view on what the worst possible outcome could be in terms of defaults, not now by people who borrowed to develop property, but people who borrowed to buy their house. So what's the biggest mortgage default that we might see? And what impact would that have on banks' balance sheets? And that informed the very substantial recapitalization next week. So far, the banks have been told to, but also it's in their own interest to, take a very easy line with people who are having difficulty servicing their mortgages. So they have rescheduled. They've said you can pay just the interest. They've said we're not going to chase you in the courts, but just keep paying us something, anything, because as long as the borrower is paying something, the bank doesn't have to write down the value of their loan in their books, and they don't have to look like they've made a big loss. But even with all this forbearance, and the government has introduced a code of conduct and so on, but even with all this forbearance, about 10% of mortgage holders appear to be in serious trouble with their mortgages. They're in arrears, or they have had to come to some arrangement with the bank to ease what they pay now. Now, that's all, if you like, what we think should have happened, who we think should have been affected. And the striking point about it is that people throughout the income distribution will have been affected. And that's before we go looking at what the government has done in terms of the tax and welfare system, which I'll come to in a moment. But I just want to focus for a sec on what do we know from the statistics that are so far available about the actual impact. What do we see when we look at the numbers that we have available? Now, of course, these sort of numbers, they tend to come from household surveys, and you get the results with delay. So far, we have numbers for 2009, which isn't bad, but obviously things have got significantly worse since then. So what's most striking, in a sense, about the numbers that we have to date is that this measure of overall income inequality that I mentioned, the Gini coefficient, I was saying that Ireland's Gini coefficient has been boringly stable around 0.31 or 0.32. In 2009, it fell to 0.29. Now, that's literally something that we didn't think we could achieve if we implemented highly progressive policies. This is something that would have been, that folk like me would have been saying, what we'd have to do to get it down is this, 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 and this. In terms of increasing progressive taxes, increasing social transfers, and so on. The minimum wage, and so on. What's striking is that what this tells you is that the first impact of the boom was to reduce incomes towards the top proportionately more than incomes in the middle and towards the bottom. Now, despite that, you wouldn't want to be fooled into thinking that all the pain was being borne in the middle and the top. First of all, there's a timing issue, which I'll come to, which makes this look particularly concentrated in the middle and the top rather than the bottom. But secondly, this can happen while if average incomes, if the whole distribution is shifting down, this can still mean significant pain and significant deprivation, increases in deprivation for those towards the bottom. And it has. If you look at this same survey for 2009, what you see is that if you try and measure not just people's incomes, but what they say about what they can afford and can't afford, that you see a significant rise in those sorts of measures of deprivation. And you'd have to hazard a guess that those measures of deprivation will have risen further in 2010 and 2011 when we have the statistics. And I won't go into the boring details, but the official measure of poverty, which incorporates those sorts of deprivation indicators, also rose significantly over that period to 29. So that's just showing you what happened to different parts of the income distribution. So this is the share of people in the bottom 10% in total disposable income. And this is the share of people in the top 10% for various years over the boom and into the bust. And what you can see strikingly is that there wasn't a proportionate decline at the bottom, but there was a marked decline at the top. Now, you'd have to assume that that's the immediate impact of a very sharp fall in profits and in income from capital more generally. But there are a couple of reasons for thinking that that is not going to be representative of the overall impact of the bust as we see numbers for 2010 and 2011. Because the phasing of the government's response is very important here. Now, you'll be glad to hear that I'm not going to go through the various measures that the government has introduced over the period. This is just to be comprehensive about it. But effectively, since that survey was carried out, the government has cut social welfare payments in a way that it hadn't up till then. The immediate impact, the immediate response, rather, of the government was on the tax side. And in fact, social welfare payments, social pensions, payments for people who are unemployed, sick, lone parents who are not working, and so on, they were actually increased in 2008 because the government hadn't yet realized just how serious the situation was. So that absence of decline at the bottom, in some sense, represents the government getting it wrong again. They didn't realize that they shouldn't have been increasing social welfare payments at a time when, apart from anything else, prices were falling. Not just other incomes, but prices. So it was a particularly daft thing to do. So they increased direct taxes by introducing a highly progressive standalone income levy in parallel to the income tax system, with no exemptions, no tax breaks, no nothing. If your income, you just paid a proportion of your income, full stop. And that was highly progressive. So the immediate response was, first of all, on taxes rather than cutting expenditure, and the form of the response was particularly progressive. Now, after that, it gets more mixed. The most striking thing they've done, this is the comprehensive list, but the most striking thing and the most important thing in the context of the distributional impact is that they then went and cut some social welfare payments. They cut, having increased social welfare payments across the board by 3%, they cut payments for those of working age by 4%, and then by another 4% in successive budgets. And they also cut universal child benefit, which had increased very rapidly in the boom. So that obviously mostly hits those towards the bottom of the distribution. What's very striking is that in cutting social welfare payments for those of working age, pensioners have been completely exonerated from having to bear any cut. So a very high proportion of Irish people aged 65 or over are in receipt of either a social insurance-based pension or a means-tested social assistance-based pension. Those were increased as the bust started and have not been cut at all. The tax increases since then have not been as progressive as the ones originally implemented, but increasing income or direct taxes tends to be progressive. But I just want to focus briefly on what was done in relation to the public sector. Because as well as increasing taxes and cutting social welfare payments for those of working age, the other striking thing that the government has done to date to try and move towards shrinking the borrowing has been to hit the public sector. First of all, by introducing a new contribution in relation to pensions, which has the same effect on your take-home pay as a tax, and then by a straight cut in nominal pay rates for public servants. Now, this is pretty unusual. It has happened in other countries, say in the Netherlands in the 80s, but it's very unusual to see actual cuts in pay rates for public servants. But these are substantial pay cuts. So when you put the pay cuts and the pension levy and the income tax increases, when you put that all together, public servants have seen their incomes fall by somewhere between 10 and 20%. So that's pretty striking. But again, in terms of thinking who's bearing the cost here, the striking thing about that in terms of the shape of the overall income distribution, those figures I showed you earlier, is that, of course, these folk are mostly in the middle and towards the top of the income distribution. Bottom of the income distribution is populated mostly by people on pensions or people relying on social welfare transfers. Even low-paid public servants tend to be maybe a bit below the middle, but not further down. So in hitting them, in the first instance, your result looks quite progressive. So the picture I showed you from the 2009 data, I think from there on is going to be more nuanced because of the cuts in social welfare payments. But even so, there still has been a significant increase in direct tax, which will be progressive, and a significant cut in public service pay, which again will be progressive. So I think the first thing to say about where we're going in the medium term, as in between now and 2015, is that it's very hard to see the fiscal targets being met if the government don't violate some of their promises. And in that sense, maybe violating the promises is the right thing to do. But then you're into the very tough issue as to whether, and again this gets debated in the UK, but it certainly deserves to be debated, perhaps more than it is in the Irish case, which is cutting public expenditure on this scale actually self-defeating? In other words, by adjusting the deficit, reducing the deficit so rapidly, are we sucking so much demand out of the economy in a short space of time that we're actually destroying the prospects of the economy picking up and growing? And you get into a situation where the austerity, however morally righteous you might feel about putting on the hair shirt, where it actually proves to be counterproductive, because instead of letting the economy start to grow and letting your tax revenue pick up as it grows, you're actually driving down the growth, reducing your tax revenue, and having to work faster and faster at the cutting in order to as you chase your tail. Now, the other issue, again, is what about this debt that we're saddled with? And Ronan gave the very scary number about what this means per head of the working population. People who, the current debate, we have now thankfully moved just about beyond the debate about bondholders and whether they should have to bear some of the burden of this, whether they should get all their money back. It's moving on now to whether we're going to be able to do this at all, as in whether Ireland is looking at a sovereign default because the debt is just too big. People I respect who are not sensation seekers are concluding that we're looking at a default over the next 2 to 3 years. Now, what that looks like may not be Argentina, where they simply say, we're paying you, 30 cents on the dollar or whatever. It may be that, in fact, the EU and the IMF, well, the EU, in effect, come to some structured agreement that, since it's them we owe most of the money to, that there will be some burden sharing between the rest of the EU and Ireland and Greece and possibly Portugal by that stage. So that's what you're going to be reading about over the next 2 or 3 years, I'm afraid. Now, just to finish on the longer-term implications, and this is where the point I was emphasizing about unemployment, that there has been strikingly little discussion of or policy in relation to unemployment, policy initiatives in relation to unemployment. You would have to think that one of the most serious long-term, if you think about long-term as being 5 years and beyond, one of the most serious things we're looking at is the very real possibility of another, as we had in the 80s, of another group of people experiencing sustained long-term unemployment and who either never get back properly into the workforce or who, if they do, suffer long-term consequences in terms of repeated experience of unemployment, significantly lower earnings, and so on. That's a very real possibility, and I think unless policy gets its act together sooner rather than later, that's likely to happen. But I think you can worry about the numbers and the banks and the billions and so on if you want to, but in a sense, what we might be better off worrying about is the long-term implications for real folk, and apart from those who are currently long-term unemployed, I think you'd have to worry about those who are being raised in families affected by long-term unemployment or unavailability of decent jobs. All the evidence suggests that children raised in severely disadvantaged households bear a cost throughout their lives that it's very hard to tackle by policy. And I guess that the final group who do get a bit more attention, because I suppose a significant proportion of them are middle class rather than working class, is those who are trapped in negative equity. There's a real generational issue here that the cuts may well affect and compound may well affect most families with young children who are in the early stages of their family cycle, got into the housing market at the wrong time, are saddled with very substantial mortgages. They're having their tax bills increased year by year. They're having their services cut, in all likelihood, year by year. They're having child benefit cut. And you'd have to think that that's a group that certainly, in terms of the political system, would probably be getting quite a lot of attention, but do deserve it. So plenty of pain for everybody who's bearing the cost, pretty much everybody, but not proportionately. And I think in the long term, these are the groups who one probably has to worry most about. So I'd be very interested to hear your comments and reactions. Thank you very much.